Welcome to today's webinar and happy 2026 to everyone. Hope you all had a happy and healthy holiday period. And wish you all a a great 2026. Today I'm going to talk about the outlook for G10 FX in 2026 with a real focus on the US dollar because we really feel like the big dollar is going to be the main driver of currency markets. That, getting the trend in the dollar right is always important, but this year I think it feels especially important with so many issues around the Federal Reserve, potential changes in tariff policy, and the broad outlook for risk and global markets feels very central on the dollar and the US this year. And so I'm going to start there and then touch on what we think about sterling sort of closer to the end. So if you can go to the next slide, please. So I want to start by talking about where the US economy is as we head into 2026, which, if I can just summarize, is an economy that has performed, I think, more admirably, more resiliently once again than most expected, but maybe in a different way than I think most expected, because where you have seen strength is away from the labor market, and where you've seen more clear weakness is in the labor market. So the labor market has slowed pretty clearly during 2025, and we think it's going to continue to remain sluggish through much of 2026. Just to give you a couple of pictures of what this looks like is on this slide. Hiring plans, so small businesses' intentions for hiring, they've picked up a touch in recent months, but private payroll growth is averaging close to zero at the moment. In fact, the 3-month moving average of private employment gains is around 25,000 jobs per month at this point, which is quite low and not that far from zero. This comes from a period of significant job growth in the immediate aftermath of the pandemic. It was very clear that there was a overabundance of available jobs and an under availability of workers to fill those jobs. As a result, we had significant job gains over that period. We had high wage inflation, and that translated into, one of many factors that translated into stubbornly high inflation in the post-pandemic period. In 2025, we saw a pretty meaningful slowdown in the pace of job gains. And what you see on the right-hand side is that even though the unemployment rate has been fairly steady, it's higher than its trough. Around 4.4% right now is a pretty admirable result considering the slowdown in job gains that we've seen, with private sector jobs, as I mentioned, effectively flat, not far from flat, and federal government workers negative because of changes in the way that the Trump administration has approached federal government employment. Employees in surveys are telling us that they're noticing that jobs are more difficult to get. So what this purple line on the right shows is, are employees telling a confidence survey that jobs are plentiful to get, or are they getting more difficult to get? And what we're seeing is that differential is starting to suggest that individuals, Americans, are noticing that jobs are not as easy to come by. We've seen a big drop in job openings. There's been a slowdown in labor demand. Jobs are not hiring as many people. But you've also seen in the US a drop of labor supply. The big driver of that has been change in immigration. You may have seen recently that the US actually had net immigration that was negative for the first time in, I believe, over 20 years in 2025. A very clear reflection of a change in tact and policy by the Trump administration. A lot of that was a decline in net migration. Some of it, of course, is deportations. But we've had a slowdown in labor demand and also a drop in labor supply. And so the unemployment rate has not ticked up materially, even though you've seen such a clear slowdown. So I think it's right to say that this is probably the clearest downside risk to the US economy, is that the labor market has slowed. Can you move to the next slide, please? But what you have seen is that outside the labor market, there have been, other bright spots in the US economy, and a really obvious, clear one has been on the CapEx and business investment side. Now, I think a lot of this is related to the AI adoption, related investment, data centers. But what you see when you look at CapEx spending, things like capital goods shipments, real equipment spending, orders as well as expectations for CapEx, you've seen some signs of recovery here. And so, broadly speaking, we have a US economy where the labor market has clearly slowed. Downside risks to the labor market, I think, have clearly picked up. But in the same vein, you've seen growth coming from other parts of the economy, in particular on the business investment side, which is notable given we've been under this cloud of tariff uncertainty for several months, that business investment showing some signs of picking up. Additionally, you've had some Federal Reserve easing that will be working its way through the system. 3 interest rate cuts in 2025. We think there's more coming later in 2026. I'll pick up on that in a second. But also fiscal stimulus coming down the pipeline. The One Big Beautiful Bill Act was passed in 2025, the big tax cut act from the president. A lot of those impacts start to hit in 2026. So we think fiscal stimulus probably also helping to maybe mitigate some of those downside risks. So we actually think the US economy is in decent shape, albeit with the biggest downside risk coming from the labor market. I think the big question, if there's one big macro question for the US economy in 2026, it's this one. It's, can the US economy sustain an above trend pace of growth with a labor market that is as weak as it is at the moment? That usually when you see downturns in the economy, those are really consistently correlated with weakness in the labor market. I think what a lot of us are asking ourselves right now is it different this time because of how the labor market, the weakness in the labor market might be as related to supply of jobs as it is to demand for jobs. Can you go to the next slide, please? So I mentioned the Federal Reserve. The Federal Reserve looks like they're on pause for now, and we think they're on pause through the end of Powell's term as the chair of the Federal Reserve in May. But what happens after that is really where, you tend to get a lot of differentiated opinion and differentiation in market pricing. And it's a really important question for the dollar because of how interest rate differentials tend to correlate with dollar performance, which is shown on the right-hand side. This correlation is one that has weakened in sort of, call it the post-Liberation Day era from April of 2025. But this is still a really important relationship that drives a lot of currency markets because front-end interest rate differentials are the primary input, the sole input into carry. So when you're holding an asset, are you earning relative to, are you paying to hold that position, or are you earning passive income from interest rates, from higher interest rates for holding that currency? So this is such an important piece of the relationship, and it's why we tend to talk so much about central bank policy because those front-end interest rate differentials are super important for currencies. The Federal Reserve is going to come under new leadership from May of 2026. We don't yet know who the president will pick to assume the role of Fed chair at that point, but it's very clear that individuals in the president's orbit are talking a different language on the need for Federal Reserve interest rate cuts. So whether it be Kevin Hassett, Kevin Warsh, there are a couple others in the mix for Federal Reserve chair, but I think they see greater progress on disinflation than the current stock of Fed members. And I think they believe that fiscal policy, changes in fiscal policy, are putting downward pressure on inflation. Now, I think we can reasonably argue that that's not the case because of tariff risks and fiscal stimulus. But I believe they think that the right course of action now is we do not need to put downward pressure on the labor market when it's already close to a potential tipping point. When fiscal policy, because of immigration, energy policy, housing policy, is going to be helping us put downward pressure on inflation. And so we think the Fed under new leadership is going to be pushing aggressively for lower interest rates. And you can see we have the Fed actually moving the interest rate down to more neutral levels, to getting the policy rate back to neutral towards the end of 2026. And that's kind of what's shown on the left with that light green line being our own expectation. You're flat for a bit, new leadership comes in, new interpretations, moving the policy rate down more quickly. This is one of many iterations of a broader question about Fed independence. You may have seen this week the criminal inquiry into Fed Chair Powell and the massive rebuke from a lot of different angles, including from some key Republican senators. I think that's given the market a sense that maybe these questions around Fed independence are not necessarily going to come to fruition, that the institutional guardrails in place, say from Republican senators or from the markets, are going to stop them from taking aggressive action. But we think that under new leadership, there's still a good case to be made. Maybe not the perfect case, but still a good economic case to be made for lower rates, and we think they'll deliver that. So we do think further compression in interest rate differentials is coming, and that's an important source of downside risk for the dollar in 2026. And we do think that this is going to be a year with broad dollar weakness, reflecting both monetary stimulus and fiscal stimulus. We just think this is going to be a very strong period of stimulus that we think is going to weigh on the dollar. Can you move to the next slide, please? So in the short term, we're always talking about growth and changes in Fed policy, how Fed policy is evolving versus the policies in other central banks. That's, of course, a major driver in the near term. And if you're tracking very closely, you'll have noticed that some of the data in the US have actually started the year on a much more positive note, and the dollar's actually bounced back a little bit from its lows seen in December. But we should also take a step back and consider the bigger picture, which is that maybe two things to consider. Number one, the dollar is still the unquestioned global reserve currency. Still over 50% of global FX reserves are held in dollars. That's what's shown on the right-hand side. That level has been coming down steadily over the past couple of decades. It was closer to 70% at the beginning of, at the turn of the millennium in 2000. Now it's closer to 50%. Additionally, foreign holdings of US assets have ballooned in recent years. And in particular, equity holdings, corporate stock holdings, that yellow bars on the left-hand side, has really picked up a lot. International investors, whether that be because there hasn't been a better growth story than the US, there hasn't been a better equity story than the US, or because the US is seen as the store of value global safe haven, international investors have flooded US markets. And in doing so, we think a lot of them have done so unhedged, that they're not hedging the currency risk over the last couple of years because number one, it's expensive because of how interest rate differentials influence hedging costs. And number two, because the dollar has actually gone up over this time. So if you're an international investor holding US equities, then your returns are coming in dollars, and those dollars are actually appreciating versus your local currency, or they have been before 2025. And so we didn't think there was a strong reason for those investors to be hedging. Now in 2025 and into 2026, we're tracking these themes, I think, a lot more closely. We don't think investors need to flood out of US market, but if their decisions around hedging the dollar portion of those exposures changes, it could have significant implications for the dollar over the longer term. Additionally, if reserve managers start to see institutional credibility beginning to be challenged, concerns around the US role in the global geopolitical landscape, our sense is that those types of investors who are over invested in dollars may shift a little bit to being maybe less over invested in dollars. Again, I don't think there's any real challenger to the dollar as the global reserve currency, but it doesn't take a massive change in the dollar's position to make major waves in currency markets. And so this is a theme that we're tracking very closely. I think the euro is probably best positioned to pick up this kind of flow. What we've seen more recently is outperformance in gold. That to me feels like maybe an iteration of this theme, that reserve managers looking for alternatives to the dollar. Gold outperformance, I think, has been a very clear sign that there is something in this trade, that there is some real potential price action in this move. And in the FX space, in the G10 space, euro, I think, feels best positioned. And frankly, the euro outlook right now is reassuringly boring. ECB looks like they're not going anywhere fast. Interest rates look like they are pretty much unchanged, for the time being. And it doesn't have that same, we think, sort of political uncertainty that comes with, the current administration and the rapid change in the way that they have been, approaching trade and international relations and markets. So we think the euro is one of the best positioned countries to potentially benefit from this type of long-term rotation. And so we do think euro dollar rallies through the course of 2026. Can you go to the next slide, please? So I mentioned fiscal policy in the US running hot. You may have seen the president is putting a lot of different proposals on the table to try and run on affordability, trying to get people to feel that prices, that prices are coming down, the cost of homes is coming down, mortgage rates coming down. He's facing a lot of these pressures because what tends to happen in midterms in November 2026, we'll get the first midterm election since Trump won his election in 2024. What tends to happen in those elections is that the party out of power tends to do really well. That's especially true in the House of Representatives. The last time President Trump won in 2016, his party got routed in general elections in 2018. On the left, we show what we call the generic ballot. In this case, we're looking at Republicans versus Democrats. So when these numbers are below zero, Republicans are underperforming, they're underpolling versus Democrats. And when we're above zero, Republicans are outperforming. So what you may notice here is that number one, you tend to get positive numbers here when Democrats are presidents. So 2014 and in 2022 with Biden. And you tend to get negative numbers, Democrat outperformance, when Republicans are president. There tends to be a really strong snapback impulse for American voters that if you vote for a Republican for president, 2 years later, you're gonna vote against that person. The generic ballot is a really good predictor of the House of Representatives, which is the more likely body to switch hands. And right now, the generic Democrat is polling about 4.5 points better than the generic Republican, which is that light green line on the left-hand side. That's a very good indicator that we should be assuming that Democrats take back the House of Representatives in November as of today. One thing I'll add here is that the yellow line, as I mentioned, was 2018 when Democrats crushed the Republicans in midterms after Trump pulled the shock win in 2016. Democrats are doing okay, but they're not doing nearly as well as they could otherwise be. They're polling well below the pace of where they were at this point in the 2018 cycle. And so this gives you a hint that even though Democrats should be the favorite, I think, to take back the House in 2026, it's hardly a guarantee. They're not polling nearly as well as I think they probably should be, given where we tend to this snapback impulse, and how you tend to get much better performance for the party out of power. So I bring this up not to necessarily preview the 2026 midterms, which are several months away still, but just to flag that Republicans and the president seem to be going all in on stimulus to try and push these numbers back in their direction. So I think that will include additional fiscal stimulus in 2026, and more recently, clearly some pressure on monetary policy to become more stimulative in 2026. We think the consequences of that kind of big stimulus push are still a weaker dollar on balance. On the right-hand side, we just very quickly show the Senate. The Senate is going to be very difficult for Democrats to win, even if they have a really good election year, just based on the way the calendar rolls out this year. Probably not worth going through this in too much detail given time constraints. And also, the House focus is really what matters, because if Democrats win the House, doesn't really matter if they win the Senate, they'll be able to force gridlock for a long time. And I think Republicans and the president are trying to change that narrative. And that's why you've seen so much push on affordability and the president just throwing out a lot of different ideas to try and get Americans feeling excited about the prospect of maybe seeing prices reduce, mortgage rates reduce, and other factors. Go on the next slide, please. Finally, I want to make a note on sterling. Interest rate differentials, as noted, are really important in currency markets. And what we have seen is sterling maybe diverging a little bit from where you have seen in front end interest rates. That's been the case in the dollar broadly. If you remember the prior a couple of slides ago, when we saw the interest rate differentials in the 2-year point and the dollar, that relationship had weakened in the post-Liberation Day period. Sterling is not immune to that weakening in the dollar relationship. But what we've been tracking more recently is interest rate differentials further out the curve and how that's related to fiscal risks. And I'll quote my colleague Paul Robson, who's been on these calls quite a bit, that the UK budget in late last year was seen as a potential significant flashpoint for fiscal related risks. But that was also a somewhat boring result And boring is good in this case. The market had been pricing significant potential downside and significant political risks around this event. We saw sterling move sharply lower into the budget. After that, we've seen sterling actually bounce back a bit. And actually, throughout the month of December and maybe less so in early January, sterling has actually been on a nice little run here. And I would describe that as an easing back of some of that pessimism. As an American, especially, and I speak to American clients, I get the sense that Americans and offshore were very worried about the UK economy, very worried about the budget, and that led to, I would consider, excess pessimism on the UK economy that has since priced out. We think it might be harder yards from here for sterling to recover, say against euro, for example. We still think that sterling recovers and moves higher against the dollar as part of a broad, weaker dollar outlook. But the fiscal risks that have priced back out, if you look at 10-year interest rate differentials, those have narrowed. That's very good news, I think, for sterling. But it's going to be, I think, harder yards from here for sterling because, the growth outlook is still in a challenging position. I don't think it's as bad as people have feared, especially going into the budget last year, as I mentioned. But there are still concerns about the labor market. And additionally, as we've, moved sort of away from acute political risks in the immediate term, but there are local elections coming up, and that could get the market a little bit more worried about potential political risks sort of eking their way back into sterling price action. So maybe harder yards from here for sterling in the near term, but we do think sterling rallies against the dollar. That's mainly a dollar story. As I would describe it, raw dollar weakness kind of being the driver there. So maybe I believe that is my final slide, and maybe that was a great opportunity to pass over to Piers.
Thanks very much, Brian. Very interesting stuff as always. This year, I'm going to split my long-term outlook into two parts. At the start of the year, I always look what's going to happen. This month, I'm going to look at what happened last year and what key levels it leaves. And next month, I'm going to look more at what's going to happen through 2026 as we enter the Chinese New Year. And that'll be a year of the fire horse. So I've got some views what could happen through 26 and not enough time to do both in one session. So I'm going to look at price action, as my views are only views and price action, what's keys is key. So I will look for clues in the previous price action. So the first chart we're going to look at is the dollar index chart. And this is the yearly dollar index chart. And what we can see is last year, the red candle, the last one, is what's called a bearish engulfing candle. So price action made a higher high. The market started off confident, we're going to go higher. But by the end of the year, it had turned round and dollar weakness came and it fell, and it was a lower close than the year before. We also had a lower low. So that actually wiped out the previous 2 years. Now, what you normally get after a bearish outside session is some people feel, we missed that move. So as price at the moment, you can see is rallying up, the dollar value is rallying up slightly. It's green this year so far. But what will happen is, as you enter into that red candle, the risks increase that actually people might start to sell the dollar again. And so that's one thing to note there, that it was a bearish outside session for the yearly chart. So if we look at the next chart, this is the dollar index monthly chart. And I like this chart because markets are just purely dynamic and they go to certain areas. Now, this trend, you can see the trend since 2011 in the dollar index has just been an upward trend, higher highs and lower and higher lows. There's also a trend line. So that trend line, it has actually hit that trend line. Well, last year, it was 7 months it held that trend line. And in total, it's around about 17 times that trend line has held the dollar index. So that's why when the dollar index hit it last year, it bounced. And you can see it's slightly rising line. So each month, the dollar index didn't make such a low as the previous month after it hit that line. So that's going to be a key line to watch this year. So I'd start by watching that trend line. If we see that trend line break, then that to me is the signal that dollar weakness is coming and you look for a move lower. at the moment, we have those two orange lines going across the chart above price action at the moment. They're what I call polarity areas. You can see that back in 2016, 2017, 2020, they were the highs of price action. So when price goes above it, it simply switches to support. So through 2022, 23, 24, it acts as support. So if price action goes back up there towards sort of the 104 area, that should be sort of resistance. But if we start to get above there, then maybe the dollar's actually picking some price action, picking some attracting interest back in to buy the dollar on a longer term play. Because if we go to the next chart, this is the dollar index yearly chart. And although we can see that on that chart, this actually helps us a lot because this shows us where the price action stalled. So the price action stalled at the 76.4% retracement. That was the high on the dollar index last year. That area capped it. And it came back down to the 50% area. Now, as a rule there, I'm just going to try and update because my slide's not updating here. Right. So this is looking at the moves from the 2000 to 2007-8 decline, and then the move back up. But we can see the 38.2% at the bottom, towards the bottom, where is also a trend line coming in, an orange trend line, and the 20-period moving average. And they all come round about 89.91. So if we do see that trend line break, then that could be an area where there's strong support. And I wouldn't write off the dollar too soon because there's a lot of people talking a weaker dollar because it's what the president sort of wants and what the Fed are maybe going to cut. But it's not sometimes politicians and central banks who actually control where price action go in markets. So, if there's a shock to the world, where people usually head to is the dollar. So I'm not saying there's definitely going to be a shock to the world, but it seems to me something you should always keep in the back of your mind. There could be a shock to the world, and that you can't rule that out. And that might see people going back into the dollar as well as they like gold. So yes, we could see a move down. If we see a move down in the dollar index, I think that 89.91 area will be good support. It'll be a retest of the trend line. But if you're going to move down there, maybe it's a break, retest of the trend line, then back higher. So my closing line on the dollar is, yes, it had a negative year last year. Yes, it could go lower, but don't write it off too soon. These things come back. Any sort of event or anything sort of panics the world, you could find the dollar back in vogue. Right, so that's the dollar index. Let's look next at the next slide. Now, this is sterling dollar. And I really like this sterling dollar chart because it helped us a lot. This chart and its retracements actually have helped me since I started in the FX markets in the 1980s. And it helped me a lot last year because in April, I warned that we were approaching the 23.6% retracement. And that level in sterling dollar has capped sterling dollar since Brexit. It was 137.88. It touched that 137.88 area and it fell back down. It just fell off it. It's where the long-term sellers are in. So that's an area I'm going to keep an eye on this year. 137.88. Is price going to get up there? If price can break through there, we might see a move higher. But why did it go down? It fell off that level. We know that. But why did it stall where it stalled? So let's go to the next slide. And hopefully this will show you why it stopped on the downside. So this is the rally up since 2022 in sterling dollar. And it's quite simple. You just stick the retracements on. And the last candle with the big spike on the bottom on it, that's the last quarter of last year. This is a quarterly chart. And you can see what was there. 129.57 was the first retracement. You also have the 20 period moving average. And that is why I feel sterling dollar bounced where it did. It went to the first retracement in an uptrend. What should happen there? It should be bought. The market bought it, and it's rallied back up to where it is now. So that's an area I'd watch very carefully this year. You need to see sterling dollar staying above 129.5, 129 area to be positive that the sterling dollar move higher is continuing. Now, we're already at 230, and so I said I'm going to split in two sides. Here are the downside. I have other slides, which now I'm going to do next month, which show me extensions where I think cable could go during 2026, but I'll do them on next month's webinar. So if we go to the next slide, thank you. This is sterling euro, and it's on the yearly time frame. So each candle represents 1 year. And this chart is another fantastic example. Like the last one we saw, you had the clue last year where the high in sterling dollar was. Very simple. It came at the first retracement, 23.6. We highlighted that risk in April, and it fell after that, hitting that line. This chart is the same. Since Brexit, it has held every rally in sterling euro. And that's why I feel it's another great example how important charts are for long-term views. I mean, too many people, I think, just look at them short-term, don't realize there's long-term players out there looking at these levels and just going, right, we'll buy or we'll sell. So for myself, at the beginning of last year, on the first webinar of last year, I said, and I warned that we are at the 21.5 area, is the 38.2%. And all that sterling did last year was weaken against the euro. It just fell through the year. Now, it had a negative year. It closed quite near the low, but something it did was it closed below the 23.6%, which I've been using as a bit of a pivot on there. So what can I see now when I look at this chart from a longer term perspective? Well, I can see that sterling euro, to get confident and positive on sterling euro, you need to see sterling euro take out the 23.6 at 116 and that 20 period moving average, because you haven't had on this chart any yearly close above that 20 period moving average. And that's coming in about 118.35. And that's why the market's just sort of stuck at the moment. If you're going to go for that 38.2, and if you're going to see a strengthening in sterling, you need that initial resistance zone to break and the market to gun for the 38.2, which is the big level to watch. Now, I think it's a strange thing because the market already this year seems to be watching that 116.09, because I noticed on the daily charts today that we've been up to sort of just below that and backed off it already. So it's going to be interesting to see how that plays out. On the downside for sterling euro, I haven't really got the levels on this chart that I really like. There are some levels I like, and I'll bring them on the quarterly chart, which I will put in next month for my second part of this yearly outlook. So we go to the next slide, please. So this is euro dollar. So this is euro dollar yearly candle. And if you look at this, we're looking at the fall from 160.40 down to sort of the 0.95 area and the retracements. Now, the first thing that stands out is last year's candle, because it's inverse of the dollar index, basically. Basically, euro dollar makes up the biggest part of the dollar index. So here we've got a reversal pattern on the downside, which suggests price action will try to the top side. But where did we stop last year? Do you remember I said long-term, people look at long-term charts and decide where they're going to sell, where they're going to buy. So where did euro dollar stop last year on its rally? It simply stopped at the 38.2% retracement of the fall down from 160. And that was at sort of the 120.20 area, is it on my chart? And all chart systems be slightly different, but it's still just ahead of that and came back down. But one thing that will give the euro dollar bulls some sort of some what's the word I'm looking for? Some hope that they are on the right way is the trend line going up, the black dash trend line, because price closed back above there. So they'll be thinking, look, we've broken back above the trend line. But one thing I'd say on trend lines and anything, you want a rule of confirmation to come in. So you want to see price action hold above that on another year. I know you might say, oh, God, it's another year, but it's a yearly chart, so we're looking long-term, big picture. You need to see that happen, and it needs to really get above that 38.2% for us to get a move higher. But at the moment, looking at the upside here, I see initial resistance around about sort of the 119.20 area and 121.40. I've written it above that chart because you have the 20 period moving average, that pink line going across the chart. And price action has used that as support. If you look back at the beginning of the chart in 1996, then in 2000 and sort of 2-3, it broke above the chart. Then 2004 to 8, then 12, it used it as support. When it broke below, it's used it as resistance. So that's why price action's struggling here. We also have a polarity line coming in, and that's the orange dashed line going across. And that is at about 125.5. And so, yes, we could get a move up to 125 if we get through that 121.40. But as I said before, I wouldn't write off the dollar too quickly. I know I'm going against the trend and everyone's like, oh, dollar weakness, but I just think let's just see how it all plays out. Because remember, what affects markets is not what is known, because that's already in the price. Everyone's views are in the price. And that's why I'm saying my view is only a view. What is key is what does price action do? And for me, it's the thing that no one's talking about at the moment. I mean, if I look back in all the years I worked in the bank, when I worked in the bank the year of COVID, no one was talking about COVID in January. No one was talking about the Russian invasion of Ukraine the next year, in January. Last year, we go back, no one's talking about Trump's tariffs in January. And those are all things that define the year. It's things that what people are not talking about, I feel, will impact it. So just be careful of those events that could suddenly come out, shock the market, could take it either way. Then you just watch where the next resistance or support levels are. But having said that, there's also times where there's bigger risks to the market, potential risk times than other times. And looking at different sort of cycles and things like that, you could see the beginning of February, just that first week in February or the first week in March, both those weeks could see a bit of volatility. But the month that worries me the most is April. So in the first half of the year, I have another month that will be later, but I'll cover that next month. But for the first part of the year, April is a month I think that could be quite risky for markets. So keep an eye out on that time. But I'll cover that more next month because I see it's 2:40. We're supposed to finish by 2:45. So I'll leave 5 minutes for questions. Thankfully, the guys doing these presentations are very good. Sam's just put up the disclaimer. That is very important. And we had the disclaimer there, and that will be on the slides we send out. But thank you very much.
So I want to thank everyone for joining, and again, wish everyone a very happy and healthy and prosperous 2026. And we hope you're able to join in our upcoming webinars throughout the course of 2026. Thank you so much.